Hey everyone, how's it going? Hopefully you can hear me. I know you can't see me. I'm having some issues this morning, right when we were going to start the session, my power went out in the building, and it's like the third time it happened this year. So I bought a universal or uninterruptible power source system that's hopefully going to be delivered today, and hopefully that takes care of the problem going forward. Even if the power goes out in the building, my computer should be able to last for a little while. So, um, apologize for this morning. I don't have my camera back online yet, but we can just go with the screen share. So yesterday we talked about how we really just expected the market to chop sideways. We aren't really expecting a directional movement, and you can see from our daily view that we just chopped sideways. We can see that also that it was a fairly large range chop sideways, but that is to be expected when you are in a high volatility environment, which we are in right now. We are currently at 19.85, so just barely below that 20 mark. 20 is when there's a lot of fear in the market and that we're probably going to see a sell-off because there of an anticipation of of money movement into safer assets outside of the stock market. So into bonds, into commodities, into other assets other than stocks. So far, what we've seen is a rotation out of the more aggressive growth sectors and into the more conservative defensive sectors. So the money has stayed in the stock market. If we get sustained movement above 20, then we'll see money start leaving the market, and that will bring the markets quite a bit lower. We are also talking about how that MA50 was very important. You can see that we spent some time below the MA50 today, but we did close above it. So we're just kind of flirting with this kind of danger point. And that's to be expected that we didn't actually have a decision on whether we're going to be safe or in danger because of the Broadcom earnings that are happening presumably in the next 10 to 20 minutes, and also because of the employment situation. So we're probably not going to see any direction until we get those reports, and maybe even not after that, because we got Jackson Hole, we had NVIDIA earnings, all of those things that had the potential to move the market, they really just didn't, at least not significantly, nothing that it didn't recover from. So, but just the employment situation, it's probably going to pan out the same way. But again, it does have the potential to give us directionality in the market. The way it's looking, though, so far is that we might just be inside this box that we drew until the September 18th Fed decision. And then we'll see what happens. If we get a 25 basis point rate cut, I don't think anything will happen. We'll just keep on chopping sideways. If we get a 50 basis point rate cut, we might get a little bit of a surge towards the top of the box, maybe a little bit outside that box, challenging the all-time highs, maybe moving a little bit higher than that. And then we'll probably chop sideways again going into the elections. And if we don't get a rate cut at all, I think this market is going to move down quite significantly because a lot of things are pricing in the basically 100% expectation that we're getting a rate cut. So you can see here 57 plus 43, that's 100%. And this was in the 60s just a couple days ago, or maybe even just a couple days ago. We were in the 60s. So there is a lot more movement heading towards the 50 basis point. And what's interesting is as we've gotten more expectation built in of a 50 basis point rate cut, the market has not gone up. It has gone down towards the bottom of this box. So that tells me that maybe even if we get a 50 basis point rate cut, and so on September 18th, the market might just chop sideways. And if we get a 25 basis point rate cut, we might start moving down. And if we get no rate cut, then we'll have an extreme movement downwards. Because the sectors that have been doing well over the last week or a couple weeks, let's see if I can view it this way. If I go to a weekly chart, okay, and I go to, now let's go to a daily chart. and just go back, let's say 2 weeks, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Okay. So if I go back to here, you can see that SMH and tech have not been doing well at all. The ones that have been doing well are XLF, XLRE, both of those highly sensitive to interest rates. XLRE a little bit more so than XLF, but XLF benefits from actually higher interest rates. And then we've got the XLP and XLU, those are defensive. So the fact that we think there's a 50 basis point rate cut and only the defensive ones are moving at the moment, but one of the better ones that have been performing have been real estate, which is interest rate sensitive, utilities, which is interest rate sensitive, financials, which is interest rate sensitive. Well, if we don't get that rate cut, then all of these ones that were doing well are just going to flop. And actually, XLK and SMH, because they're competing with yield, they are interest rate sensitive as well. They should be. If interest rates go down on bonds, then comparatively the yield on tech stocks should look better, and that should boost up the tech stocks because money will say, hey, I can get 3% on a treasury bond, or I can get 15% on tech. And I go, oh, well, that 15% looks a lot better. But the fact that money hasn't been moving in there, that says, oh, even though maybe I can get 15% on tech, maybe it's not worth the risk right now. So overall, these markets are not in good shape. They're not healthy at all. And there's a lot more scenarios where we go down than there are where we go up. And I've been saying that in slightly different ways for a few weeks now. But at the end of the day, the fact is that there's a lot more ways that the market can go down than there are for the market to go up. So we should start to lean our portfolio that way. We're still, on the most part, neutral. But if we break below this MA50 on the S&P 500, we're definitely going to start leaning a lot harder towards the bear market. Not fully, because we won't be fully bears until we go below that MA200, but at least we would lean a little bit towards the bearish side. Right now, for the most part, we're still neutral, with the possible exception of some tail risk trades to the downside. So if we go below the MA50, then a example combination might be we have 3 or 4 long short pairs and then one non-paired bearish trade. That's how we start to lean our portfolio. So right now, we just need to see if that employment situation in Broadcom actually does anything, or if we just keep on chopping sideways. We are flirting very close to that MA50, and these moving averages, these shorter term moving averages, are starting to converge. So that is an indicator of we're either going to break down or those moving averages will converge and we'll just keep chopping across it. So right now, I don't have a clear picture of which one of those two cases is more likely. And I guess maybe I would say if I had to choose one, I would choose chopping sideways, just because the catalysts that we have coming up just don't seem like they'll be strong enough to give the market a direction until we hit September 18th. So the ones that we've got tomorrow, yeah, normally it is a pretty big catalyst, but given that we had other catalysts that were at least as big, if not bigger, Jackson Hole should have been a bigger deal than an employment situation, and the market did basically nothing. So just based on that, this employment situation might not do anything, and we might just chop sideways. But again, normally we would expect this employment report to give at least some directionality to the market. With the elevated VIX, though, you just want to be sure we don't confuse a large range day with actual directional movement. And we do that by zooming out and looking at the perspective like this. And we can also see that our ATR currently is at 7.38. Today's range was, let's see, close to close. was only 1.34. So I mean that's close to close. We can see the intraday range. The intraday range high to low was 6.7. Okay, so still below the normal ATR. So even though it may have felt very directional today, which at certain points in time it did, you can see that it looked pretty directional for the first hour and a half. And then we looked very directional to the downside for the next hour and a half, 2 hours. And then we kind of flattened out towards the end of the day. So don't get too excited. Just know that right now volatility is high. We expect a large range during the day, but not necessarily a large movement from close to close. Let's take a look at our momentum levels. It's been a little bit since we've done that just because we've been chopping forever. But I do want to just get an updated view of the momentum levels. We want to stay on top of it every once in a while, even though it's not as relevant right now. So stocks above $2, we got 51% above their 50-day moving average, 56 above their 200. That's not super healthy. And that's just not too far away from getting below the 50-day MA, and not a terribly large amount of cushion for the 200-day either. Let's take a look at our sectors, or we can look at our major indices first. S&P 500, 66.71. That's okay. The Russell 2000, 62.66. That's okay. I would say normally we see around 65 to 70 in a normal healthy market, sometimes up to 80. So these aren't too bad. And then Dow, same thing. And NASDAQ, this is where we're seeing trouble. 48% above their 50-day moving average. And then we've got 59 at the 200. So this is the first signs of cracking right here. And if we start seeing this move down, then we're going to start seeing it bleed into the S&P 500. And then we'll see it potentially. We'll see if money stays in the markets, the Dow Jones could stay relatively strong. But if money starts leaving the stock market, then you'll see the Dow Jones break down as well. Let's take a quick look at our sectors. Looks like energy is doing terribly. Momentum wise, let's see, XLE. Okay, so chopping sideways, break down below that MA200, looking like it could at least test these lows right here. But then I would say that originally we were trading in a sideways box. Over here. And now we're trading, oops, I didn't stick. And now we're trading like this. We'll see what happens. If we break down and keep on going down, that is very recessionary. Energy does not like recessions at all. So we can see that during COVID, energy got hit really, really hard because that was a recession where no one went anywhere and everyone stayed at home. So especially that, because a lot of manufacturing, a lot of businesses were shut down. A lot of people weren't driving all that much. Yes, they were at home using electricity, but that's not nearly the same amount as industry uses and transportation uses. So we can see that huge breakdown in energy. And actually, that was the first time in history where energy actually reached negative prices. So people were trying to pay people to take energy because there's nowhere to store it anymore. There's nowhere to store the oil or the coal or whatever form it was taken in. So recession, this would be indication of recession if we move downwards. If we move up and break above this, then that would be more potentially inflationary. And then if we stay in this box and chop sideways, then we're kind of middle of the road or maybe slightly deflationary. So we'll see. We'll be looking at energy as a leading indicator. And then let's see what else wasn't doing well. Looks like tech. Yeah, that's not too surprising. Tech Let's take a look at tech. XLK still finding some support at this annual VWAP, but it's right there. It crossed the last 2 days. So, and we're right at that MA200 that's creeping up as well. So all we need to do is chop sideways a little bit more and we'll be flirting with the MA200 as well. And if that breaks down, then we're going to see a cascading effect. QQQ starting to break down, going towards its MA200, and we'll see if that holds. The only thing that will allow it to hold is if XLY continues to do okay. So right now it's looking reasonably okay. I wouldn't say it's great, but it's looking not bad. It's above all of its major moving averages, and it's just been chopping sideways for the last couple of weeks. So it's been doing okay, but QQQ, if it starts getting dragged down by the tech component and starts hitting that MA200, we have the potential of breaking through and then having a bleed into the S&P 500 as well. So overall, I would say that there's a lot more bearish forces starting to operate in this market. That doesn't mean we're bearish yet. Like I said, we're still in a portfolio neutral position, just waiting to see if those bear forces start to accumulate and get even worse. So for now, yes, we have a bearish lean, but we're not bears. We're just, right now, we're, for the most part, neutral. Just look like a lot of messiness, a lot of choppiness, but there are more and more signs of weakening in the market and potentially recessionary signs in the upcoming 24 months, but probably sooner than that, maybe next 12 months. There's forces building up that look like may turn into recession. So that's something that we want to be aware of. That's something we want to be prepared for. That probably means that we're going to be adding, sprinkling tail risk trades into our portfolios, hedges into our portfolios, whereas for most of the time, we don't have those things. We just have normal positions. We don't necessarily have a portfolio hedge or load up on a lot of downside tail risk trades. So you'll see me probably talk about that a lot more. And then if we go full on bear, then of course, then most of our positions are pointed to the downside. So just be prepared emotionally for it. So when it happens, we don't freak out. we have a plan, and actually we make a lot more money a lot faster in bear markets than we do in bull markets. So the fortunate thing is that for the last few months, we've kind of been in this sideways neutral because we saw the bearish forces building up on the way up. We actually went neutral probably around June-ish. I would say actually right at the beginning of the summer. It's about the time we went more neutral, or maybe that's first pullback is where we started to get more neutral. So we didn't take full advantage of this next surge upwards, but we sure took advantage on the way down. And if it continues to move down, we'll be taking advantage of that as well. And we can perform a lot faster because the downward movements tend to be a lot sharper than the upward movements. This was an exception. This is a V-shaped recovery, but you can see that this took 1, 2, 3, 4, 5, 6 days to go down, and then 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19 days to get back to the same level. So generally, we move down a lot faster, and that's why we can make money a lot faster in bear markets. So it's nothing to be fearful of. It's just something to be ready for, so that we can take the action and take quick action, because the market does move faster on the way down as well. We'll see what the employment situation is going to have in store with us. I really don't have a good idea. I have a sense that we could get directional. I don't have a good sense of if it's going to be up or down. And then let's take a quick look and see if Broadcom announced before we end. Looks like they did not do well. So this is what I was talking about yesterday. We may consider a tail risk trade to the downside because there's a lot more negative forces or downward bearish forces in the market and in the semiconductor space than there is to the upside. You can see the initial reaction was way up here, but we traded down very quickly. This is a huge bar. Recovered some, but then the next minute it kept on trading down, and it looks like we're tapering off. That doesn't mean we'll be here tomorrow morning. We saw a similar thing happen with NVIDIA, where when the market opened, it traded up, but then by the end of the day, and then within a few days, it was down. So let's take a quick look at NVIDIA. On their earnings, you see they announced after earnings here, and it was down, and then they traded up, but then the next day it just kept on going down. So we may see something similar with AVGO. We did not actually I did not actually show you guys or do it in any of my official portfolios, a tail risk trade, just because I'd rather be neutral. But this is what I was talking about, where the downside forces are just so much more and so much stronger than the upside forces at the moment. I don't know what the numbers are. We don't have the numbers yet for Broadcom, but I have a suspicion that they're probably okay, or they probably did well, just like NVIDIA did well, but it's down anyways. So that's just a reflection of the markets right now and the forces in the markets. We're probably going to see, if the employment situation doesn't save us, then it does look a little bit more like we'll probably have a breakdown below that MA50 tomorrow. We'll just see if it turns into a rout or if it just kind of mildly goes down. So tomorrow should be a pretty exciting day. Hopefully you guys are in neutral portfolios with slightly bearish leanings or edges and tail risk to the downside, like we've been talking about. And if you are, then you'll do just fine. So I will see you guys tomorrow morning. We'll see how everything plays out, and have a wonderful rest of your day.